the world and on our views of the world are profound. Noise, in the sense of a large number of small events, is often a causal factor much more powerful than a small number of large events can be. Noise makes trading in financial markets possible and thus allows us to observe prices for financial assets. Noise causes markets to be somewhat inefficient, but often prevents us from taking advantage of inefficiencies. Noise, in the form of uncertainty about future tastes and technology by sector, causes business cycles and makes them highly resistant to improvement through government intervention. Noise, in the form of expectations that need not follow rational rules, cause inflation to be what it is, at least in the absence of a gold standard or fixed exchange rates. Noise, in the form of uncertainty about what relative prices would be with other exchange rates, makes us think incorrectly that changes in exchange rates or inflation rates causes changes in trade or investment flows or in economic activity. Most generally, noise makes it very difficult to test either practical or academic theories about the way that financial or economic markets work. We are forced to act largely in the dark. I use the word noise in several senses in this paper. In my basic model of financial markets, noise is contrasted with information. People sometimes trade on information in the usual way. They are correct in expecting to make profits from these trades. On the other hand, people sometimes trade on noise as if it were information. If they expect to make profits from noise trading, they are incorrect. However, noise trading is essential to the existence of liquid markets. In my model of the way we observe the world, noise is what makes our observations imperfect. It keeps us from knowing the expected return on a stock or portfolio. It keeps us from knowing whether monetary policy affects inflation or unemployment. It keeps us from knowing what, if anything, we can do to make things better. In my model of inflation, noise is the arbitrary element in expectations that leads to an arbitrary rate of inflation consistent with expectations. In my model of business cycles and unemployment, noise is information that hasn't arrived yet. It is simply uncertainty about future demand and supply conditions within and across sectors. When the information does arrive, the number of sectors where there is a good match between tastes and technology is an index of economic activity in my model of the international economy. Changing relative prices become noise that makes it difficult to see that demand and supply conditions are largely independent of price levels and exchange rates. Without these relative price changes, we would see that a version of purchasing power parity holds most of the time. I think of these models as equilibrium models, not rational equilibrium models, because of the role of noise and because of the unconventional things I allow an individual's utility to depend on. But equilibrium models, nonetheless, they were all derived originally as part of a broad effort to apply the logic behind the capital asset pricing model to markets other than the stock market and to behavior that does not fit conventional notions of optimization. These models are in very different fields: finance, econometrics, and macroeconomics. Do they have anything in common other than the use of the word noise in describing them? The common element, I think, is the emphasis on diversified array of unrelated causal elements to explain what happens in the world. There is no single factor that causes stock prices to stray from theoretical values, nor even a small number of factors. There is no single variable whose neglect causes econometric studies to go astray, and there is no simple single or multiple factor explanation of domestic or international business fluctuations. While I have made extensive use of the work of others, I recognize that most researchers in these fields will regard many of my conclusions as wrong, or untestable, or unsupported by existing evidence. I have not been able to think of any conventional empirical tests that would distinguish between my views and the views of others. In the end, my response to the skepticism of others is to make a prediction. Someday, these conclusions will be widely accepted. The influence of noise traders will become apparent. Conventional monetary and fiscal policies will be seen as ineffective. Changes in exchange rates will come to provoke no more comment than changes in the real price of an airline ticket. Perhaps most important, research will be seen as a process leading to reliable and relevant conclusion only very rarely, because of the noise that creeps in at every step. If my conclusions are not accepted, I will blame it on noise. 1. Finance. Noise makes financial markets possible, but also makes them imperfect. If there is no noise trading, there will be very little trading in individual assets. People will hold individual assets directly or indirectly, but they will rarely trade them. People trading to change their exposure to broad market risks will trade in mutual funds or portfolios or index futures or index options. They will have little reason to trade in the shares of an individual firm. People who want cash to spend or who want to invest cash they have received will increase or decrease their positions in short-term securities or money market accounts or money market mutual funds or loan backed by real estate or other assets. A people with information or insights about individual firms will want to trade, but will realize that only another person with information or insights will take the other side of the trade. Taking other side's information into account, is it still worth trading? From the point of view of someone who knows what both the traders know, one side or the other must be making a mistake. If the one who is making a mistake declines to trade, there will be no trading on information. In other words, I do not believe it makes sense or to create a model with information trading but no noise trading, where traders have different beliefs and one trader's beliefs are as good as any other trader's beliefs. Differences in beliefs must derive ultimately from differences in information. A trader with a special piece of information will know that other traders have their own special pieces of information and will therefore not automatically rush out to trade. But if there is little or no trading in individual shares, there can be no trading in mutual funds or in portfolios or index futures or index options, because there will be no practical way to price them. The whole structure of financial markets depends on relatively liquid markets in the shares of individual firms. Noise trading provides the essential missing ingredient. Noise trading is trading on noise as if it were information. People who trade on noise are willing to trade even though from an objective point of view they would be better off not trading. Perhaps they think the noise they are trading on its information, or perhaps they just like to trade. With a lot of noise traders in the market, it now pays for those with information to trade. It even pays for people to seek out costly information which they will then trade on. Most of the time, the noise traders as a group will lose money by trading, while the information traders as a group will make money. The more noise trading there is, the more liquid the market will be, in the sense of making frequent trades that allow us to observe prices. But noise trading actually puts noise into the prices. The price of a stock reflects both the information that information traders trade on and the noise that noise traders trade on. As the amount of noise trading increases, it will become more profitable for people to trade on information, but only because the prices have more noise in them. The increase in the amount of information trading does not mean that prices are more efficient. Not only will more information traders come in, but existing information traders will take bigger positions and will spend more on information. Yet, prices will be less efficient. What's needed for liquid market causes prices. What's needed for a liquid market causes prices to be less efficient. The information traders will not take large enough positions to eliminate the noise. For one thing, their information gives them an edge, but does not guarantee a profit. Taking a larger position means taking more risk. So there is a limit to how large a position a trader will take. For another thing, the information traders can never be sure that they are trading on information rather than noise. What if the information they have has already been reflected in prices? Trading on that kind of information will be just like trading on noise. Because the actual return on a portfolio is a very noisy estimate of expected return, even after adjusting for returns on the market and other factors, it will be difficult to show that information traders have an edge. For the same reason, it will be difficult to show that noise traders are losing by trading. There will always be a lot of ambiguity about who is an information trader and who is a noise trader. The noise that noise traders put into stock prices will be cumulative, in the same sense that a drunk tends to wander farther and farther from his starting point. Offsetting this, though, will be the research and actions taken by the information traders. The farther the price of a stock gets from its value, the more aggressive the information traders will become. More of them will come in, and they will take larger positions. They may even initiate mergers, leveraged buyouts, and other restructurings. Thus, the price of a stock will tend to move back toward its value over time. The move will often be so gradual that it is imperceptible. If it's fast, technical traders will perceive it and speed it up. If it is slow enough, technical traders will not be able to see it, or will be so unsure of what they see that they will not take large positions. Still, the farther the price of a stock moves away from value, the faster it will tend to move back. This limits the degree to which it is likely to move away from value. All estimates of value are noisy, so we can never know how far away price is from value. However, we might define an efficient market as one in which price is within a factor of 2 of value, i.e., the price is more than a half of value and less than twice value. The factor of 2 is arbitrary, of course. Intuitively, though, it seems reasonable to me in the light of sources of uncertainty about value and the strength of the forces tending to cause price to return to value. By this definition, I think almost all markets are efficient almost all the time. Almost all means at least 90%. Because value is not observable, it is possible for events that have no information content to affect price. For example, the addition of a stock to the Standard & Poor's 500 index will cause some investors to buy it. Their buying will force the price up for a time. Information trading will force it back, but only gradually. Similarly, when a firm with 2 classes of common stock issues more of one class, the price of the class of stock issued will decline relative to the price of class of stock not issued. Both price and value will look roughly like geometric random walk processes with non-zero means. The means of percentage change in price and value will change over time. The mean of the value process will change because tastes and technology and wealth change. It may well decline when value rises and rise when value declines. It may well decline when value rises and rise when value declines. The mean of the price process will change because the relation between price and value changes, and because the mean of the value process changes, price will tend to move toward value. The short-term volatility of price will be greater than the short-term volatility of value. Since noise is independent of information in this context, when the variance of the percentage price moves caused by noise is equal to the variance of the percentage price moves caused by information, the variance of percentage price moves from day to day will be roughly twice the variance of percentage value moves from day to day. Over longer intervals, though, the variance will converge. Because price tends to return to value, the variance of price several years from now will be much less than twice the variance of value several years from now. Volatilities will change over time. The volatility of the value of a firm is affected by things like the rate of arrival of information about the firm and the firm's leverage. All the factors affecting the volatility of a firm's value will change. The volatility of price will change for all these reasons and for other reasons as well. Anything that changes the amount or character of noise trading will change the volatility of price. Noise traders must trade to have their influence. Because information traders trade with noise traders more than with other information traders, cutting back on noise trading also cuts back on information trading. Thus, prices will not move as much when the market is closed, and they move when the market is open. The relevant market Here is the market on which most of the noise traders trade. Noise traders may prefer low-priced stocks to high-priced stocks. If they do, then splits will increase both liquidity of a stock and its day-to-day volatility. Low-priced stocks will be less efficiently priced than high-priced stocks. The price of a stock will be a noise estimate of its value. The earnings of a firm multiplied by suitable price-earnings ratio will give another estimate of the value of the firm's stock. This estimate will be noisy too. So long as noise traders do not always look at earnings in deciding how to trade, the estimate from earnings will give information that is not already in the estimate from price. Because an estimate of value based on earnings will have so much noise, there will be no easy way to use price-earnings ratios in managing portfolios. Even if stocks with low price-earnings ratios have higher expected return than other stocks, there will be periods, possibly lasting for years, when stocks with low price-earnings ratios have lower returns than other comparable stocks. In other words, noise creates the opportunity to trade profitably, but at the same time makes it difficult to trade profitably. Econometrics. How do people trade on noise? One reason is that they like to do it.